I also just wanted to, now that we can put them up there, I wanted to show the results of Monday's poll. In the first poll, you'll remember I asked you to consider 5 countries in which the government controls different percentages of the economy, 10%, 25%, 33%, 50%, 75%. And I asked you what the largest level of government control was, where you would still say the country is a free market economy. And the median and modal response was, of the choices I gave, was 33%, which is, of course, a number that is lower than government spending over GDP for all of the G7 and Israel. And as we also talked about before, government control of the economy is not only government spending as a share of GDP, because even in sectors that are not specifically government spending, the government is also doing a lot of regulation. So seems like, based on your priors, some questions about whether these are actually free market economies today. The second poll I had asked you was just about the amount of unfunded obligations of the United States, so debt plus unfunded retirement and medical care programs, and that per capita was $238,000 per U.S. person, which is, of course, another limitation to freedom, particularly prospectively, because somebody is going to have to pay that back either through higher taxes or is going to experience much higher inflation. So that's a review of the previous poll. So now we're going to go to the next poll here. So now your poll everywhere should update here. Do you agree or disagree with this statement? The wealthy do not pay their fair share of taxes. And you can't see it on the screen right now, but you'll see it on your own device screen that you can also strongly disagree with that if you like. There strongly agree, somewhat agree, neither agree nor disagree, somewhat disagree, or strongly disagree. So I'll give you a moment to do that, and then hopefully my method for showing the results will work properly. So I see about 14 of you have responded. We're going for 25. Don't think too hard, just whether you agree or disagree. It's not a factual question. It's just an opinion question. All right, 15, keep going. I don't know, maybe people are still logging in or registering or something, but I'll give you a minute. Okay, 16 responded. I want to see near full participation here. Yesterday we got to 25, so I feel like today it should be possible to get to 25. I don't know if it's asking you additional questions or if you're drying your hands, or I don't know what 19. Okay, now we're getting there here. I just want to see above 20. Okay, I'm going to give you just a few more seconds. I feel like people are still 19 people have figured it out. Just give another few seconds here to. Okay, I don't know why yesterday people were, maybe there were some more people in the room, but we have 19 people, so I'm gonna lock it now, and we're gonna see the responses. Okay, so here are the responses. Okay, so some now the percentages are cut off, but I can read out the percentages to you. Okay, so it obviously didn't. My method for showing the results did not fully work, but that strongly agree is 5%. The somewhat agree is 36%. Maybe I can even manage to zoom out here a little bit. Okay, so nope, that didn't do it either. That didn't show them either. So oh well. Strongly agree was 36%. Neither agree nor disagree was 5%. Somewhat disagree was 18%. Strongly disagree 36%. Okay, so basically, I would say if you add up strongly disagree and somewhat disagree, we ended up with about a little over 50%, but 36% of you somewhat agreed and 5% of you strongly agreed. All right, so so let's keep going. Oh, there it is again. Okay, again without the percentages, but okay. So what do people think in international polls about income inequality? Here's the share of respondents who agree or strongly agree with the statement that differences in income inequality, differences in income in your country are too large. 63% of people in the United States say this. 82% of people in Germany say this. 72% of people in Israel say this. Japan, Australia, people are concerned about income inequality. And one of the challenges with these polls is, it's often hard to disentangle how much is concerned about income inequality versus just people don't like the fact that someone else out there is earning more money than they are. Okay, but that's the nature of the polls. But people are concerned about income inequality. And in Israel specifically, if you ask about concerns, what are the issues that most concern the public? This is a May 2022 poll, so it was before the events of October 7th. But if you look at what the results are, tensions between groups in Israeli society, obviously we have seen a lot of that. 18%. Housing prices, something we just discussed recently with Omer, 18%. But economic inequalities is right up there with the other ones. Okay, above the future of the education system, the Iranian threat, the climate crisis, predicted demographic changes, fall in the economic growth rate. And among the share of respondents with the highest incomes, 10% cited economic inequality, while those with the lowest incomes, 22% cited economic inequality. All right, so I guess, while it is true that people with lower incomes are more likely to be concerned about inequality, also people with high incomes are concerned about inequality as well. So what's the big picture and the big questions? What we're going to talk about now is what is actually going on with income inequality in the world, in the United States, in the G7, in Israel, and how much should or shouldn't the government use redistributive policy to address income inequality? So on Monday, we were talking about different justifications for government. What were some of those justifications? As a review, we were talking about, first of all, the need to be able to have a rule of law and enforce contracts. That was sort of the most, in the kind of free market philosophy, that's kind of the most important role of government. We also talked about the social safety net. We talked about market failures potentially in areas like education, health, or infrastructure. And we also talked about this idea of smoothing over shocks. And we kind of arrived at the end of that lecture with the idea that there's a lot of potential for overreach in a lot of those, although probably the most important thing the government can do is rule of law, enforcing contracts. That's something that you need government in place to do. All right, so that's where we got. But we didn't talk about, what about just pure redistribution? Some people have a lot more money than others. The government should just be there to redistribute it. What about that hypothesis? Or some people are earning a lot more money than others. The government should just redistribute the money from the rich to the poor. What about that? So that's what we're gonna consider today. How necessary is that? How much of it is going on? How necessary is it? And how much should redistributive policy aim to address income inequality? So we have another poll here. And again, sorry for the formatting, but hopefully it will appear okay on your phones. Approximately what share of total income does the top 20% of earners in Israel earn? And I see it hasn't updated on my phone yet, but I will. Oh, there we go. Okay, no, you might have to refresh. Approximately what share? This is a factual question. So this one, if you Googled, you would get it right. But don't Google. Actually, it doesn't come up that quickly in Google. ChatGPT might be able to find it pretty quickly, but it's from a report. I want you to just give your best estimate of what it is, just based on what you think. What percent of total income does the top 20% earn? So if you imagine, imagine all of the salaries and income of everybody added up, right? And we're gonna
only salaries? Only salaries? So
all income. Okay, but not including government transfers, government transfers. What percentage do they earn? Okay, so to have a think about that one. And 20 of you have answered. Okay, great. 21 of you have answered. Very good. So I think this is just a kind of factual question. We're going to lock it here. We're going to look at the responses. Maybe we'll be able to even see the response. Well, unfortunately, again, we can't see you get the idea. It's supposed to show the percentage of each of you that said each one of these. At least what we can see from here is nobody said 20%. Okay, and that's good, because if 20% of the people earns 20% of the income, there would be no income inequality. I mean, the press, we're going to see in this, the press has gotten a lot of this wrong, but they haven't gotten it that far wrong. There is some income inequality. Okay, so at least we're clear on that. Okay, so some people said 40%, some said 60%, and some said 80%. I'll read out those numbers. 18% of you said 40%. 36% of you said 60%, and 45% of you said 80%. Okay, so basically almost. So I would say that what that means, just doing the math, 82% of you said that it was more than 40%, said it was either 60% or 80%. And now I'm going to tell you what the actual number is. The top 20% in Israel earns 44% of the income. So 40 is closest. Some of you said 60 might say, well, yeah, it's greater than 40. Okay, that's true. But it's not 80. The top 20% earn 44% of the income. All right, so next thing I want to do is, yes?
What would that number be in the US?
Well, I'm going to show you that after we do the Israel example. Coming right up. Next thing I want to do, the next poll is, this is not a factual question. This is an opinion question. Okay, this is about what it is that you believe. You know, if you are in charge, if you were a benevolent dictator, given that the top 20% earn around 44% of the income, what percent of the income tax burden should the top 20% bear? And let me just explain this. This is not what tax rate should you impose on them. This is the question of, if we imagine all of the tax that the government brings in, how much of that tax should be paid by the top 20%? So here are the some of the choices that you have. So one answer might be 20%. Some of you might say, I don't care that they earn 44% of the income. Everybody should bear an equal share of the tax burden, 20%. That would be the justification for 20%. Okay, how about 44%? Well, 44%, the fact is they do earn 44% of the income, so maybe they should bear 44% of the taxes. That would be the 44% answer. And then you have some other answers for more progressive levels of taxation, 50% of taxes, 75% of the taxes, or more than 90% of the taxes. This is just, we're just exploring what your beliefs are about sort of social welfare functions, right? So, and redistribution. So feel free to give that an answer if you haven't yet. And give me a moment to sort of get the update here and see how people are doing. Okay, we've got 17 responses. I know we can get up to 22. Maybe some people are doing research.
I think there should be some type of middle ground between like the 20 and the 44. That's a huge.
I want between 50 and 75.
You want a middle ground? Okay, so people want various middle grounds. I appreciate that, right? So one middle ground people want is between 20 and 44, which is to say that we're going to go. We're not going to go with it person by person, but we're also not going to make them pay 44% of the taxes. That's one middle ground. Another one is, well, we want some progressive taxation, but you don't want it to be as progressive as 75, but you want it to be more progressive than 50. Fair enough, but choose one. Choose the best one that you can, and let's see where we stand on this. Okay, 22 have answered, so I'm going to lock it, and we're going to look at their responses. All right, and as usual, I think we're probably not going to see the percentages when we do, but you can at least see who's winning. So some of you said 20%. The modal answer was 44%. Then the second most popular answer was 50%. And 75% have a little more than 20%. Nobody said 90%. And I'll read off the exact percentages for you. That 20%, only 9% of you said 20%. So you're the ones who believe it doesn't matter that the top 20% earn more than the others. Everybody should bear an equal share of the tax burden. 44% is, all right, whatever percentage you earn of total income you earn, that's the percentage you're going to contribute to the total government budget, in a sense. 50%, had 32% of you said 50%, 14% of you said 75%. So not a lot of huge fans of progressive taxation overall. Progressive taxation is actually anything above 44%. That's the sort of definition of progressive taxation. And I guess about 44% of you, so about half of you are in favor of some type of progressive taxation.
It was noted that the income tax is only less than 50% of all income taxes of the state in Israel.
Whoa. You said the income taxes are less than 50% of the income taxes of the state of Israel. The revenue, okay, yeah. Well, that's because there's fees for services and things like that. So the VAT, which is relatively Sure. Yep, fair enough, fair enough.
And in the bracket, it is less than 44% for the top.
Yes, fair enough. Let's see though what the, I mean, these are good points, but let's see what the actual share is. I mean, you must be curious what the actual share is. That the total income tax paid by the top 20% is 92%. 92% of the top 20 of 92% of total income taxes are paid by the top 20% of earners. So we have a much more progressive income tax here than you might think is warranted, at least based on your responses. Okay, point about the VAT taken, and we might want to take that into consideration. Still, if I want to compare this, I want to compare this to the United States, and where we don't have a value-added tax. And when you get people together and you talk about this, you have a very similar phenomenon that takes place. Okay, so here is the U.S. income distribution. This is the income of the top 1%, the top 5%, the top 10%, and so on as a share of the total. To be in the top 1% of earners in the United States of America, you need to earn $548,000 per year. Okay, and the median is $42,184. So that's the income distribution. When I tell people in America, in the United States, at sessions at Stanford, classes at Stanford, or at the Hoover Institution, this is the income distribution. And I ask them what percent of federal taxes should the top 1% of taxpayers pay. These are the results that they give me. All right, so they say, well, all right, you told me that that the top 1% earns 22% of the income. You get a pretty similar kind of response to what you gave me relative to the Israel numbers, which is to say that the modal response is either 22% or 30%. So about a third of the people just say, well, they earn 22% of the income, they should pay 22% of the taxes. Another 31%, again, about a third, want some progressivity in there. They want the top 1% to pay 30% of the taxes. And basically, very few people want them to bear 40% or more of the taxes. But then you tell them, okay, well, here's actually what happens. Actually, the top 1% are paying 42% of the taxes. They are bearing 42% of the tax burden. So yeah, in the U.S. we have a lot. There are a lot of studies where we know what the top 1% are earning. So we did this with the top 1%. In Israel, the best numbers I could find, at least, based on the resources that I was able to access or decipher, was for the top 20%. But the bottom line is still the same, which is that people generally tend to overestimate the share of income earned by top earners, the top of the income distribution. And then when you tell them what the share is of the income earned by the top of the distribution, they tend to say that without telling them what share of the taxes they actually bear, they tend to say numbers for the share that those higher income people should actually bear that are lower than what the top earners actually do bear, lower than the share that they actually do bear. So so interesting, and I guess the question that often comes to mind is, well, where do people get their sort of general ideas about the income distribution and about inequality? And often they're getting them from the press. So here's, the predominant media narrative. I picked out some things that highlight both U.S. and Israel. U.S. and Israel have worse inequality in the developed world. The CNN Business, major U.S. news provider. Income inequality in Israel among the highest in OECD from Haaretz. Yeah.
Where are you drawing the line? I mean, when you're saying that 20% of the earners are earning 44% of the income, it might be like the top 10% earning 43% of it, and
sure.
It's like, where do you draw the line? Because eventually, 100% of the earners earning 100% of the income, so everyone should pay 100%.
Well, yeah, it's good you asked that. I mean, again, in the U.S. At Stanford, when I do this exercise, I usually do it with the 1%. But I guess the point is that when I've run this poll in many different ways, no matter where you draw the line, the pattern is kind of the same, which is that people overestimate whatever you call it the top X% share. People tend to overestimate that share, and then when you tell them what that share is, they tend to want that group to pay less, bear less of the overall tax burden than they actually do. So it's wherever you draw the line, you kind of get the same pattern. Okay, yeah. So going back to the news, right? So income inequality in Israel among the highest in the OECD from Haaretz. One group of people who I will talk about in a moment that you read about a lot is economist Thomas Piketty. So Piketty wrote a book called Capital in the 21st Century, sort of after, in allusion to Karl Marx's Das Kapital, which has gotten a lot of press. And economist Thomas Piketty explains why income inequality is just getting started. Massive new data sets suggest economic inequality is about to get even worse, so predicting that it's going to get worse. Super rich increase their share of the world's income. This stuff is all over the media, and people consume it. It's clickbait, all right? People like to read this stuff. It gives people a certain feeling. You go, oh, wow, inequality. There are people out there who are making more money than I am, people out there who are richer than I am. This seems like something I should maybe be concerned about. Maybe something devious or unfair is going on here. Maybe the government needs to correct it. That's all kind of the direction that the media is going in. So where do some of these claims come from? Well, the claims, for example, that Israel and the US have the highest inequality in the world, these are not totally incorrect claims. And where do those claims come from? It's an incomplete claim, but it's not totally incorrect. So let me explain why it's incomplete. Israel's economic inequality is measured by the Gini, if you measure it by the Gini coefficient, is close to the OECD average for market income. So what is this Gini coefficient? All right, so the Gini coefficient creates a graph here where you have just the population poorest to richest on the x-axis, and on the y-axis you have the cumulative percent of national income that they earn. So one thing you know about this graph is that once you get up to 100% of the population, they earn 100% of the income. But if you drew a line here that's at 50%, what percentage of the national income does the top 50% earn? If you had perfect equality, they would earn 50% of the income. You can do the same thing with the number that we use. We were talking about the top 20%. That would be somewhere here, 80th percentile. What percentage of the income do they earn? If they earn 22 cumulative percent of the national income, then that would be full equality. If you have less equality, then the cumulative percent of the national income is actually going to be underneath that line, which might be counterintuitive, but if you think about it for a minute, you'll figure it out. The actual income distribution looks more like that, and the Gini coefficient is A divided by A plus B. So that's the Gini. So you don't need to get the details of it, but the basic idea is that it doesn't consider, and this kind of goes to your question, where do you draw the line? Do we care about the top 1%, the top 10%, the top 20%? The Gini coefficient summarizes over the entire income distribution. And it is true that for disposable income, both the US and Israel are well above the OECD average. Actually, this should say for market income. There's a mistake in the oh no, sorry. Yeah, the slide is correct. For market income, Israel is right here, right near the OECD average. And the United States is somewhat above the OECD average for inequality. So what does market income mean? This is before the government starts taxing and redistributing the income. So as far as market income is concerned, the headline, Israel has highest inequality in the world by Haaretz, that is not true. If you just look at income that people earn before the government gets involved. Before the government gets involved, Israel is right around the OECD average. Once you look at what happens after the government gets involved, Israel moves up, and the United States actually comes out at the very top. So what does that fact pattern tell us? It tells us that the main reason that Israel and the United States are coming out higher up in this distribution here has to do with the fact that these countries do less redistribution of income. They do less redistribution. If you go to just the distribution of what people earn, inequality is not that high in Israel. But Israel does not do as much redistribution as the other countries. So putting a headline up that says Israel has highest inequality among the OECD is a bit misleading. What it means is that Israel's government policy does not do as much redistribution as other countries do. And whether that's good or bad, that's a policy question. But it's kind of a mistake to forget about what underlies this, which is which is market inequality, what the inequality is of market income. And so again, this implies that there's a similar market income distribution of Israel to the OECD average, but different amounts of redistribution. Yeah.
But isn't it exactly the point of what they say? Like, people care about how money they get; they don't care about how money is written in the check.
Well, that's true, right? I mean, that's correct. If your benchmark is going to be how much redistribution the average OECD country does, then Israel does less redistribution than the average OECD country. That should be the headline. I think different people will take that information and say different things with it. Some people might say, well, this means now that Israel needs to do more income redistribution to make its after-tax, after-transfer disposable income redistribution look more like the rest of the OECD. We want to do something. We want to do what they're doing. Other people might say, wait a second here. It's not the case that the ultra-rich or super successful in Israel are earning much more than the poor relative to some other countries. That difference is so great. It's just the case that we have a different kind of government policy. So I think you can take different things away from that. Yeah.
I mean, I don't know, but there's something intuitively to me in the question, because I think, as far as I know, I don't know the Israelite tax system all that well, but I think that the marginal rate, a very high marginal rate, kicks in at a very low relative income. I think
yes.
I think it's a much more punitive tax system here than it is in the United States. If that's correct, what I just said, that's counterintuitive to what you're saying. So it could be that there's really a lot more latitude here for the wealthy to escape taxation. You know?
Well, flatter taxes, so like value-added taxes, and also high rates that kick in at a lower part of the distribution, that's going to lead to less redistribution. And so I think that is actually consistent with these patterns.
Higher marginal rates is going to lead to less?
No, not higher marginal rates, but where the top tax rate kicks in. Where the top tax rate kicks in. In the United States, the top tax rate does not kick in until you're at the top 3%. In Israel, it kicks in much lower. And so that's one of the reasons that we're seeing this the way it is. I don't know if that makes sense. But you said something about opportunities for tax avoidance? I don't understand that point, so maybe you want to...
It was just a follow-up to my first question,
yeah.
which you say is not correct, but I still don't get talking about it later.
Okay, we can talk about it later, but a system where you have a VAT and you have an income tax that's kicking in at a lower quantile or percentile of the income distribution, that's Israel, versus the US where you don't have a VAT and you have a highly progressive income tax system where the top brackets don't kick in until you get to the top 3%. The US one is going to be less progressive, and the Israel one is going to be more progressive. But we're comparing US and Israel here. So, I mean, that's...
I think in Israel, again, we're talking about the VAT.
Yeah.
Is part of the calculation, I guess. In the United States, it seems to me that we're ignoring what's happening at the state level.
There are state income taxes, but if we go...
But there's also state sales taxes.
Yes, that's what I meant, state sales taxes. Yeah, there's state sales taxes and there's state income taxes. But these calculations are all in. These include all of these. So, this is what the OECD's... The OECD tries to incorporate all of these considerations, and to me, frankly, it makes sense, right? I mean, I think the U.S. actually has a system where there's a fair amount of income inequality, and the government doesn't do as much redistribution as the rest of the OECD, and Israel similarly. So the media focus on U.S. inequality in particular, but also global inequality, centers around three people: Piketty, Saez, and Zuckman. And you're allowed to make fun of. You're not allowed to make fun of very many people anymore, but you are allowed to make fun of the French a little bit, I think. They are all French, although Emmanuel is now a U.S. citizen. So they present income and wealth inequality as a severe issue in America. There is a lot of media coverage on this, and this media coverage has led to has led to a fair amount of sort of emboldened them in some sense to call for essentially much higher taxation on higher incomes, much more redistribution is shown here. I mean, I don't think they're ready to get out the guillotines yet, but they are very much telling the United States, hey, you guys have way too high income inequality, and you have to do more redistribution to address it. Okay, so what is where do these numbers come from? What is their approach to measuring income inequality? Well, they've been doing this for some 20 years now. They'll do things like they'll look at what is the top 10% share of income over time. You can see that top 10% share of income in the United States was in the mid-30s in the 1970s and through around 1980, and then it started going up, and now it's around 50%. The top 1% share was around 9 or 10%, and then according to these statistics, go up to be around 20%. So this is the kind of basis on which these points are made to begin with. Now this is market income, right? This is not after the redistribution. This is before the redistribution, and so before, they show these very, very large increases in income inequality starting in the mid-20th century. Where are they getting the information? They're using data from tax returns. They're presenting pre-tax income, and it excludes Social Security, it excludes transfer payments, it excludes employer health care contributions, and a lot of government policy that levels this out. So it's been highly influential. Former director of the Office of Management Budget said, "SEI has helped shape my own thinking and has had no small influence on the President of the United States budget." So this has been very much very influential. There have been some refinements to it. Okay, so they themselves refined it a bit. They got some criticism. People said, well, first of all, you didn't look at after tax. What about after tax and after transfers? And there, they also say that it's not as sharp an increase as they had previously said, and they made some adjustments to certain things. People pointed out that if you only look at tax returns, there are a lot of things you're going to miss that aren't in the tax returns, like the things that I mentioned on the previous slide. So they do aim to apportion total national income, and they find that pre-tax there's still a big increase. After tax, I mean, there is still an increase. The question is, how concerned about this? How concerned should we be about the overall level, starting out at 32% of income? How concerned should we be about the increase, which is now up to approaching 40% of income? How big a deal is this? So that's what they do. They still are finding the top 10% received about half of the income of economic growth, the income growth from 1979 to 2014. That's less than in the 2003 study, or less than the study where they weren't considering these other factors. And their solution is that U.S. has to adopt a much more strongly progressive tax system. So this is from CNBC. Here's why this economist says the perfect tax rate for the rich is 75%. And I mean, okay, I guess they're entitled to their opinion about what the optimal tax rate would be. We talked before about the fact that they're also basing these optimal tax rate calculations on the idea that you can implement very, very high taxes and there won't be much avoidance, there won't be much offshoring, there won't be many responses. The media sure goes all in on this. It's not true that all economists, or most economists even, necessarily would say that the perfect tax rate for the rich is 75%. Probably at this point, there's a kind of predominant view among economists, or maybe more than half would say that tax rates should increase. But this is quite a headline. There are economists out there who say that the perfect tax rate for the rich is much, much lower than this. They don't get covered in the news. So it's sort of not a popular message if you want to say you think the tax rate in the rich shouldn't be this high, but for some reason the media really loves this. So okay, so that's what you're going to read about. So what about redistribution? So do we need more redistribution? Well, we're already doing a lot of redistribution in the United States. And Omer Moab yesterday, I guess this was when he gave his evening lecture on Monday evening, he was showing pre-tax and after-tax distributions for different groups of Israeli society. This is sort of the US version of this by quintiles. So if you look by quintile, the lowest quintile of income, they are receiving in transfers around, on average, $18,000 per household. They are not paying any federal taxes. The second quintile is receiving less transfers, are paying more taxes, and so on. When you get up to the top, the highest quintile are receiving a very small amount of government benefits, but they are paying on average around $80,000 per year of federal income tax. So they're already, it's not that we don't have a redistributive system in place. There already is a fair amount of redistribution. People are calling for more. Another set of evidence about redistribution is based on the Tax Foundation's calculations of the progressivity of tax burdens at all of these levels across these quintiles. So they have, they're breaking it down to state and local taxes, federal taxes, and total taxes. State and local taxes in the U.S., to the extent that we have sales taxes, they are at the state and local level. So, and those are, you see, if you look at the dark blue bar, state and local taxes, those tend to be not highly increasing across the quintiles. You can think of this as like a net tax or subsidy rate as a percentage of income. They're modeling, they've got the income of people, and so that's not highly progressive. The federal one is highly progressive. Then overall, you get a highly progressive system where the net tax rate, you know, this is net of transfers. The net tax rate in the top quintile is 41.4%. The net in the bottom is 10%. So it's not that we don't have progressivity. So the debate about this income inequality has continued. This is just what we saw on the previous slide. These are the Piketty and Saez and Zuckman income inequality numbers, pre-tax and after tax, and so they were out there with the numbers for a while. Then some government economists came along from the Joint Committee on Taxation and the Treasury, and they said this: we are the government, we have access to the government data, and this Piketty and Saez stuff is not actually accurate. So they made a few points. I think the biggest point has to do with the fact that everybody knows that the tax returns don't necessarily reflect all income because some people are underreporting their income or are doing things to evade taxation. And Piketty and Saez, and that's a big deal. You know, there's a lot of tax evasion that goes on. Piketty and Saez and Zuckman, they kind of allocate all of that to the people who are already in the top 1% or 0.1%. So they say those people, we think those, you know, we're going to look at those people, all this unreported tax income, that must be from them. But if you think about that, that's a really bad assumption. I mean, I think the way that this, the popular fact about this, you might remember that there are a couple years where Donald Trump didn't pay any income taxes. So just because you don't pay income taxes, just because you're in the low part of, and that means his taxable income was very low, just because you're in the low part of the income distribution, does not mean, it does not necessarily imply that you don't have underreported income. I'm not claiming he has underreported income, but my point is just that the taxable income that you see, that may not be a good reflection of what the total potential might be for underreporting income. And so that's a big deal. That ends up affecting these estimates a lot. And these guys, because they're at the US Treasury and the Joint Committee on Taxation, they have access to a lot more data than Piketty, Saez, and Zuckman do. And they also have conducted audit studies. They know exactly when they go after people, they actually know what the income what the distribution is of underreported income. And underreported income is much more evenly distributed than the Piketty, Saez, Zuckman folks are saying, much more evenly distributed. And it makes sense, right? If you're reporting zero taxable income, you know, that could very well be because you're underreporting all of your income, right? I mean, yeah.
There was also a change in tax code, right?
Yes. In the 1980s, there was a change in the tax code, and that change in the tax code led a lot more corporate income to become individual income. That was sort of the bottom line change. The reason for that was that if you have a corporation, your company pays corporate income tax rates, and then when you send the money out to shareholders, they then pay individual tax rates on that. So changing the tax rates, the corporate versus the individual tax rates, can change people's decisions quite a bit whether to have their business be an incorporated company or whether to have their business be what's called a pass-through entity, which is you don't have the corporation layer, you just pay your ordinary income tax on all the income. And the changes that were made in the 80s shifted a lot of the business activity over to these non-corporate entities, these pass-through entities, which is the money that shows up on these income tax returns. So that's another reason that you see this. Now, they're all of these authors are trying to deal with that. They try to apportion the corporate income tax across the corporate income rather across the entire income distribution and try to say, okay, how much of the corporate income is actually earned or owned by the top 1%, and so on. So other issues include dependent tax filers. Most college students out there, millions of college students, for example, in the United States, they're still dependent on their parents. They're not earning very much income, but if they earn a little income, they have to file a tax return, and then they look like they're poor when their parents might be paying $80,000 a year in tuition for them. Okay, so that's a big problem that affects millions of people. These dependent tax filers, or even teenagers who earn above a threshold. They also have to file for income taxes, but their parents still claim them as a dependent. That's another problem, and so on. So there are many problems that these folks correct, and what they ultimately find is that let's just take the top 1% income share. If you look at the after-tax, after-transfer top 1% income share since 1960, well, it's basically kind of hovered around the same level. And these are government economists from the Joint Committee on Taxation and from the U.S. Treasury, and these are folks who have been there for a really long time, right? When I tell my colleagues about these numbers, sometimes the first thing they say is, well, these must have been Trump appointees or something. No, that's not what happened. These are serious government statisticians who have been around for a long time and did not agree. They're reading these headlines, these numbers and these headlines, attention-grabbing headlines, and they just said, based on what we see in the data, this is not correct. It is, one thing to keep in mind is if we look at market income, so this is the pre-tax income, the red line, that has increased somewhat, right? Top 1% was at around 10%, and now it's closer to 15%. But that's kind of a different question. Why has the distribution of income, of earned income, changed so much over time? And if you're interested in income inequality, I actually very much urge people to think about that question, which is a question about labor markets at different parts of the income distribution. And it's not just the top 1% that have seen increases in their incomes and in their overall disposable resources. If you look at this is over here is just on the left is the real median household income of the United States. That is now it's grown from 55,000 in 1984 to 70,000 in 2021. Real, right? So adjusted, and that's pre-tax on the left. If we look across quintiles of income and we account for all of the government spending programs as well, it's the first quintile that has had the most growth, and it's pretty flat across the other quintiles. And that is because in the 60s you had this big increase in expansion in government programs. So real after-tax, after-transfer income has grown across all quintiles, most of all in the lowest one, showing the effects of these redistributionist policies. So it's not, so you hear these statements, it's only the top 1% that has benefited from economic growth. That's just not true in the data. These sources, this is the Federal Reserve's own data here. So sometimes it's just a matter of looking at government statistics. This is from a paper by folks. It's not easy to go and figure out when you put in all of the government programs, many of which don't show up on tax returns, what's the distribution of growth. And so this is the best and most widely acknowledged attempt to try to do that. Yeah.
I'm sorry, I'm lost.
Okay.
I'm trying to understand what you're trying to prove, and I actually pretty much lost in the middle. What's the theory that you're trying to prove?
Okay, so the point that I'm trying to make is, number one, there's been a lot of attention called to the idea that there's been massive increases in income inequality. That comes out in the press. It's come out in these Piketty and Sayez and Zuckman papers. Massive attention to the idea that the top 1%, the notion or claim, the top 1% or the top 10% are the only ones who have benefited from the growth of the last half century. But in fact, when you actually go and look at the studies and you look at the data and you look at what underlies that claim, that's not a well-founded claim. That in fact, first of all, earned income, the inequality in earned income, market income, just differences in wages, salaries, and investment earnings, that has not increased by as much as these folks say. And when you look at actual redistribution from taxes and transfers, meaning government programs, you add that in, income inequality has not increased at all. So that's the main thing I'm trying to say, which is that if you look at the data, income inequality after tax and after transfers has not increased at all since 1960. The top 1% are still receiving the same share of the income in 2020 as they did in 1960. Yeah.
According to these graphs and data, it means that the tax rate must have gone higher in this time, right?
Yes. Yes.
So and also it must say that if it wasn't going up, then the inequality was increasing.
Correct. Definitely, because the dashed red line, as I mentioned before, the dashed red line does show that the top 1% share went up from 10% to 15%. And for the top 10%, you see it going up from about 35% to about 40%. So this is an important distinction. Earned income, market income, salaries plus investment income, there has been an increase in inequality of that, but the government policy has completely offset that, so that by the end, after you're talking about after tax, after transfers, the top 1% and top 10% income shares are just the same. And what has happened is, yes, tax rates have gone up in a lot of different places in a lot of different ways. This is all in, right? This is including all state level income taxes. California, I'll talk about this in a minute. California in 2012 raised its top marginal tax rate from 10.3% to 13.3%. Now it's 14.4%. So states have done a lot of tax increases. And then the amount of redistribution through government programs has increased a lot. Continues to increase, right? So in the 60s, it increased a lot, putting in place the framework for much more generous healthcare benefits, for example, going forward. The Obamacare, changes in the Affordable Care Act, change in our healthcare system in the early 2010s, that played a big impact, had a big impact as well.
So does it mean that maybe the title is over, dramatic or something, but doesn't it say that we should keep increase taxes to keep the inequality the same? Otherwise, it will.
Well, maybe. I mean, that's it's okay if you want to believe that. I guess the point is just that these economists are saying we need a 75% tax rate. And why? I mean, right now, it seems like the tax rate we have right now has been sufficient to, if your goal is no increase in disposable income inequality, the current government policy has, the changes in government policy over time have done that. Now, maybe you say, okay, well, income inequality is going to keep going up, so therefore we need to keep raising raising the tax rate. I don't know. I mean, a forecast that market income inequality will keep going up, I don't know where that would come from. You have to see if it does or not. I also wonder, I mean, based on your responses at the beginning, I'm not sure you were all thinking what we need to do is make sure that the top 1% or the top 10% that their disposable income share does not go up at all. I mean, I don't know if is that really a good goal? How about the top 50% income share? We don't want that to go up at all. I mean, is that really what you want? You don't want, you think that all the gains to all economic growth should be just kind of evenly distributed? I don't know. I find that, I mean, that becomes a sort of political, philosophical question. Okay, what about wealth inequality? That's the other piece of it. Okay, people talk about income inequality. So the bottom line so far, again, is after tax, after transfer, income inequality has not increased. Market income inequality has increased, but not by as much as the headlines will tell you. About wealth inequality. So have those risen? Okay, so again, two of the three authors, Piketty did not do this research, but Saez and Zuckman did, so that's the asterisk. So to avoid confusion, instead of calling that the French study, I'll call that the University of California, Berkeley study, because after all, Saez is American now, and I mean, they're both at Berkeley. so we'll call it we can make fun of Berkeley. I like to make fun of Berkeley a little bit, Stanford thing. So they claim massive increases in wealth concentration, right? So here's the top 1% share of wealth. So that's also been covered very highly in the news. So top 1% share of wealth started out in 1960s at being in the upper 20s, went down a bit into 1980, and now it's gone quite a bit farther up to 35%, according to these authors. One thing to keep in mind here is that there is no administrative wealth data in the United States, because while some states tax people's wealth on death, the country does not actually, neither the country nor the states have a wealth tax. There's nobody actually collecting this data. So someone has to go and try to create a data set for wealth that measures the wealth of each person. And the way that people have done that is they've tried to do that based on people's income tax returns. Again, could be a tricky exercise, right? If you looked, I mean, I gave the example before of there was one year where Donald Trump's businesses had a lot of losses. He had no taxable income that year. If you try to then impute what his wealth was based on that year, could be tough. So, so problems, no administrative wealth data, and so you have to guess at things like interest rates. So they're doing things like, oh, well, this person reported $1,000 of interest income on their tax return. We're going to guess at what interest rate they paid, and we're going to try to convert that $1,000 into a wealth number, right? So we said, well, maybe they earn 10% on this. We're going to, oh, okay, well then, if they earn 10%, then they would have $10,000 in wealth, and we're going to impute that. Doesn't account for things like Social Security either, even others who have reevaluated the assumptions, though, have found that there's still substantial increases, right? So these folks this other group of authors tried to sort of stress test the assumptions of Size and Zuckman. In the end, actually found that the interest rate issue, that sort of guessing at interest rates wasn't as big. But there are a few things going on here that are important to note. One is that this measure is very, very sensitive, or is very highly dependent. The evolution of this series is very dependent on a couple of things. One is the performance of the stock market. And the stock market was going down in the 1970s, and it has been on a long-term tear since about 1980. And so obviously higher income people own more assets, so you're going to have increases in wealth concentration based on that. And another is the level of interest rates, to the extent that people own bonds instead of stocks. When the interest rates go down, the value of bonds go up. But what also goes up, though, is the value of government programs like Social Security and government pensions. So here are the numbers from the previous slide, right? So this is the increase in the top 1% share of wealth, but the thing to keep in mind that's been shown by a group of these authors here, that if you consider the fact that people in the United States have a very generous Social Security program and a highly progressive Social Security program, that Social Security wealth, that those promises, what that does is that really changes the picture quite a bit. So there, once you include Social Security, you actually find that they had very little. The top 1% had a very small increase in the share of wealth. How does this work? Why is Social Security wealth? I mean, it seems like, it's in the United States, it's pay as you go, it's unfunded, but it's built-in redistribution from higher income to lower income people. And the lower income people can count on the fact, and they test, you might have heard of Social Security is underfunded, it's going to get cut. Yeah, it could get reduced, but they actually factor that in as well in a bunch of robustness tests. And even if it gets cut, could get cut by 10 or 20%, it still is offsetting the growth in the top 1% share of wealth. So how does it work? Why are these pensions a kind of wealth? Think about it this way, right? So the person on the left is closer to your age, and that person has been earning some income, and they have been paying into the Social Security system with the income that they've earned since the time that they've been working. And they know that's going to continue until retirement. Okay, this person over here, so the person on the left, the person closer to your age, they know the government's taxed me, but they owe me money in retirement. So this person knows that they're going to get money in retirement from the government. Knowing that you're going to get income in the future that's guaranteed, that is equivalent to wealth, right? We call that pension wealth. I mean, it's the present value of future payments. This person over here has retired. They started to receive money from the government, even when they're, I don't know, if this person is 75 or 80, if they're still gonna, they know they're still gonna continue to live for some number of years, or expect at least to live for some number of years. They also still have pension wealth because they're getting this check from the government, and they know they're going to keep getting it. If there's any doubt in your mind, just think of, we have these products in the markets called annuities. You can take your money right now, $1,000, you can buy an annuity with it. That means you go to an insurance company, and they will take that $1,000 for you, and they will break it up into a monthly payment that they will pay you for the rest of your life, right? So that the $1,000 was your wealth, and the right that you own to those payments, that's also your wealth. And so this person says, I've been getting money from the government since I retired, and I'm gonna keep getting it as long as I live. So even though you can't access these currently necessarily, these future national insurance payments are a form of savings to an individual, and they're actually a form of, the people who are higher in the income distribution are paying in more than they're getting out, but they're still getting something out. And you can just use a present value formula, which will tell you what the present value of that income stream is. So when these folks here correct the wealth stats, right, where they say, all right, well, we have to actually consider the fact that everybody, people in the economy are entitled to these pensions, even accounting for the fact that they might be cut or taxes might be increased. They still are finding minimal growth for the top 1% and 10% when they account for these programs. So it seems like this is a very important part of the wealth distribution that hasn't been considered. It's already, it's legislated, it's in there, right? People are gonna get this. So there's less wealth inequality than we had thought. All right, so, okay, but what about, let's go back to the point that was made before, which is, okay, but pre-tax inequality has increased. The difference between somebody who's at the median and somebody who's at the 90th percentile of pre-tax income inequality, the difference in their earnings before the government gets involved, that has increased. Not by as much as Piketty and Size and Zuckman say, but it still has increased. And what they will say, what Piketty and Size say, they suggest that there's a connection between pre-tax inequality and marginal tax rates via borrowing. So this graph over here shows the highest marginal federal tax rates, and this thing has gone up and down. So it was very high to pay for World War I, then it came down in the 1920s. Then after the Depression, it went up, and it was at some point the marginal tax rate for high-income people was over 80%. This is why Piketty and Size and Zuckman say, well, we did it before, we can do it again. And then it came down. It's come down, actually. That top marginal tax rate has come down, although the tax base has broadened. And so the average tax rate, that's including the deductions and how broad the base is, that thing has come up, and it's kind of been relatively stable over the last several decades. So Piketty and Sias say that, well, there's a reason that you observe higher income inequality at a time when the tax rate is lower. Higher income inequality when the tax rate is lower. And the reason that they would give for this is not a reason that I would give for this, but their explanation for why do you see higher inequality when the tax rate is lower is they say when tax rates are low, high income people are incentivized to more aggressively bargain on the wages. So essentially they are, when tax rates are low, they're going to expropriate their employees. The benefits to expropriating employees are higher. That's this kind of sort of view around why, this is why these folks think that when tax rates are low, you have more income inequality. So, okay, the rich people then can benefit more from ripping off the poor. Yeah.
The philosophical question is
Yeah.
who pays the tax?
Yes.
So if you have a contract between the employee or the employee, and eventually the government gets a percentage, and you can think of it as if it comes from the pocket of the employee, but the same way you can think of it as it comes from the employer.
Yeah, I mean, certainly payroll taxes, for example. You know, we think of them, we think of those, we ask that question, what's the incidence of a payroll tax? Is it on the employer or is it on the employee? I think that's a good point. What these folks are saying is they're saying when tax rates are low, the greedy managers have more of an incentive to rip off lower income people. That could be going on, although I think there's a better explanation for why it is. I mean, and again, the phenomenon they're trying to illustrate is why it is that, I mean, so this is the top 1% income share. It's gone up a bit. It's gone up. And the tax rates have come down. Why is it that these things seem to be negatively correlated? I think a better explanation for why it is that you have more, you have this correlation that when tax rates are low, you have more income inequality has to do with the labor supply of high income individuals. So the taxable income of high income individuals responds to tax rates. And this is something that has kind of been denied, but I have a paper where we show this very, very clearly using this tax rate increase in California. So California, as I mentioned before, raised its own marginal tax rate from 10.3% to 13.3% on top of a federal rate of 39.6%. And this was a really clean setting because it was really just on high income people. You know, it was the increases started kicking in at around $500,000 for married couples and $1 million for single individuals. And, or sorry, other way around, $500,000 for single individuals and $1 million for married couples. So, so they raised the top marginal tax rate from 10%, 10.3% to 13.3%. And as those tax rates went up, the pre-tax federally reported income of taxpayers who remained in California went down relative to non-residents. So we were able to observe these income trends here between California residents and non-California residents when California put this into place. And so you see relatively stable trends, or parallel the parallel trends, we would call that, before the time of the tax increase, and then suddenly these differences emerge between California residents and non-California residents. So higher tax rates lead to less generation of income. This is the Laffer curve kind of Laffer curve notion, right? So higher taxes lead to higher income people having less incentive to invest in their businesses, less incentive to supply labor, and more incentive to find ways of sheltering their income. Yeah.
Do you try to dive into the mechanism? I mean, do you suppose that people work less or avoid taxes more? How?
It's difficult based on the data we have access to really figure that out, because one thing I will say is we don't find that investment income is driving this. So it's not that their investment income is necessarily going down. We do see impacts in wages, and we see a lot of impacts on business income, but we can't really say whether is that investing less or is that finding ways of avoiding taxation. That's a tough thing to do with tax authority data, since avoiding taxation by definition kind of means not reporting stuff or shifting around your reporting. Yeah, so I think that a much cleaner explanation for why it is that we see higher wage, or we see a higher top 1% income inequality when tax rates are lower, a much more kind of logical explanation is indeed that when tax rates are higher, that discourages economic activity by higher income people. And when tax rates are lower, it incentivizes more economic activity. And so, yeah, you're going to have more income inequality when you have lower tax rates due to the labor supply of high income individuals being responsive. I think that's a better explanation than what these folks are saying, which is they say, yeah, well, when tax rates are low, it's particularly valuable for the rich, wealthy, powerful people to expropriate the poor because they get to keep more of the fruits of their expropriation. I mean, it's a very sort of, it's no wonder that he wrote a book called Capital in the 21st Century. It's very much a kind of framework of like the high income people, ripping off, exploiting the poor. But I think if you look at what the evidence shows, it shows that high income people are very, very sensitive to tax rates in terms of the amount of income that they earn. It's that Laffer curve analogy. And as I mentioned last time, California, when they made this tax increase, they were not over the top of the Laffer curve. That means that they still brought in additional revenue from increasing these tax rates, but they brought in less revenue than they would have had these upper income people not changed their behavior so much. And in fact, within 2 years, there was an erosion of what I refer to as the windfall tax revenues. It's the amount of tax revenues that they would have gotten had people not changed their behavior. There was an erosion of around 60%. So that means that we were, you're not over the top of the Laffer curve, but you're approaching the top of the Laffer curve. And also, as I mentioned before, the state income taxes were at that time deductible against the federal taxes, which meant that that 13.3% that the top income people bore, because they were paying federal rates of around 40%, the true impact of those state rates on their net disposable income was less than 13.3%. It was about 40% less than that, right? So that's going to be end up being around 7% instead of 13.3%, and so that was the way it was at that time. Now, the state taxes are not deductible against the federal taxes, and so what's going on now is that the individuals actually do face a higher wedge between the cost of their living in California versus, say, another state. That's 60.9%. That includes both this stayer income effect as well as some people moving out of California. People moving out of California, that got covered by the news, actually, because that's this kind of easy thing for the news to understand. It's like, okay, people pulled up moving trucks. Taxes went up. They pulled up moving trucks. They left the state. They moved to Nevada. They moved to Texas. They moved to Florida. These are states that have zero income tax. So that's something they could understand. But quantitatively, that's not nearly as important as this effect that we were showing as well. I mean, we also document the moving. But quantitatively, this intensive margin effect is much more important. You raise income tax rates on people, they will provide less economic activity. They will generate less economic activity. Why are we so obsessed with these top income people? Well, in California, the top 1% pay 50% of the taxes, right? I mean, and we saw, in the overall U.S. example, the top 1% pay 42% of the taxes. So if you want to know where the goose is that's laying the golden eggs, it's those people, and you want to think carefully about tax policy, about raising tax rates on them. So I would say if people ask me, can California raise much more revenue currently by continuing to raise its marginal tax rates above what it is now, which is, again, now it's 14.4%, not federally tax deductible, I would say they're unlikely to be able to raise much more income by continuing to raise income tax at this point, because even back then, when it was deductible at the federal level, when the people were only bearing around 40% of the cost of, or 60% of the cost of their state taxes, even then we still had this erosion of 60%. So here's another international perspective on income inequality. A lot of the academic literature and media attention has been placed on looking at these individual countries, right? What's income inequality in Israel? What's income inequality in the United States? What's income inequality within each of these countries? But you have to consider the fact that of the global high-income population, if you look within countries, say you look at the lower-income people within the United States, those people are still relatively quite a bit better off than poor and low-income people in other countries. So individuals considered poor in developed nations would be wealthy by global standards. So here's one way of looking at it. This just shows you the percentage of the global high-income population and the global poor and low-income populations by region. And so you can see that the high-income people, 46% of the high-income people are in North America. 41% of them are in Europe, and this is based on income, and where the countries here in the graph are shown in GDP per capita. Poor and low-income people, 73% of them are in Asia and the South Pacific. So philosophically speaking, I mean, there's this question: how much should any given country or society care about just the income distribution of the people within their country? I mean, the press has kind of told us to worry about this a lot. We should really worry, they kind of, with these headlines, we should really worry about the fact that within our country, we have these people who are earning more, these people who are earning less. But it's not totally clear that that's really the right question to be asking if you're just kind of interested in humanity. What does it mean to focus on inequality? I mean, here's an example for you. Okay, consider this is a really simple example. Consider this: your boss, you're the worker here, and your boss gives you a 10% real raise. Good news, you got a raise. Your real income has gone up by 10%. So real meaning, even after inflation, right? So if inflation were 4%, they actually gave you a 14% raise. But so your real raise is 10%. Most people would be pretty happy about that. I don't get those kinds of real raises very often. Okay, but suppose I did, or you did, you would be happy. If that's all you were, great, you're happy. But what if you got the following additional piece of information? Your boss, who gave you that raise, who told you about that, ooh, they got a 12% real raise. Oh, so that means that inequality has gone up. But before I told you about this, you were happy. You were happy because you're doing better than you were before. But now all of a sudden, oh, well, the boss got a bigger raise than I did, so maybe I should be unhappy about all this income inequality, right? Again, this goes to, we looked at all of these statistics. Income inequality for the top 1%, top 10% shares, if you calculate it right and you look after taxes, after transfers, it hasn't changed. But even if the market income inequality has changed, or even if in countries where it's changed to some extent, how much should we really be worried about that? Shouldn't we be just mostly concerned about how the different parts of the income distribution have how their income has grown over time? We would be happy about the 10% real raise, but once we find out that the boss got a 12% real raise, well, that's bad because that's increased inequality. Inequality has grown, but both of you are better off than before. So it's a philosophical question. I think the philosophical question was best expressed in this in this video here. This is Margaret Thatcher's final appearance before the British Parliament, and as you know, the British Parliament has a tradition of grilling the Prime Minister mercilessly on a very, very regular basis. And here she was on her last day as Prime Minister. So her time as Prime Minister was about to end because people in her party, she lost the support of people in her party. And this is something that happened on that last day.
There is no doubt that the Prime Minister has in many ways achieved substantial success. There is one statistic that I understand is not, however, challenging, and that is that over her 11 years, the gap between the richest 10% and the poorest 10% in this country has widened substantially. How can she say at the end of her chapter of British politics that she can justify many people in a constituency such as mine being relatively much poorer, much less well-housed, and much less well-provided than it was in 1979? Surely she accepts that is not a record that she or any Prime Minister can be proud of.
Mr. Speaker, all levels of income are better off than they were in 1979. But what the Honourable Member is saying is that he would rather the poor were poorer, provided the rich were less rich. That way you will never create the wealth for better social services as we have. And what a policy! Yes, he would rather have the poor poorer, provided the rich were less rich. That is a liberal policy.
Okay, so he said people in my district are relatively worse off than they were in 1979. Relatively worse off, right? He did not say they were absolutely worse off. He said relatively worse off. And that relatively is surely relative to people in some other districts. And so his statement was perhaps not untrue. I don't know. I haven't gone back and looked at the statistics, but I have no reason to doubt that perhaps his district has received less economic growth than other districts. But the fact is that all of the districts had increased in their standard of living and their income and their quality of life. Britain had seen growth across all of them over the time, a long time. Baroness Thatcher's 14 years, I believe, as Prime Minister. And so her statement was, apparently you would rather that the poor were poorer so long as the rich were less rich. You would rather, if we go back to our example of the raises, maybe you'd rather have the worker not get the raise as long as the boss does not get a higher raise. And so that is the problem with thinking about income inequality in these terms, is that a blind focus on income inequality leads to bad inferences about how much better off people might be relative to the past. And so we started out the lecture. We were talking a lot about the statistics. First I asked you what you thought would be a fair distribution of income and tax burdens. Then we moved and we talked about what the income inequality statistics actually show relative to the press reporting. Press reporting is showing explosion in income inequality, but in fact, income inequality after tax is the same in the United States as it was in 1960, and before tax, it has increased to some extent, but not by as much as the news will show you. And then we sort of moved to thinking more in a kind of philosophical sense about, well, why is income inequality important? Why should we care so much about income inequality? My contention would be that it's not that we shouldn't care about it, but primarily we should be concerned about whether all parts of the income distribution are better or worse off than they were before. I'm less concerned that the boss got a 12% raise, real raise, if the worker also got a 10% raise. Now, okay, what about the fact that the red dashed line, even when the government economists redid it, the market income inequality? The market income inequality is still going up. It still is the case that before the government gets involved with taxes and transfers, it still is the case that higher income people, the difference between higher income and lower income people is increasing, even though government policy has undone a lot of that. So I think that's a great question. And if you're interested in studying inequality, that is the question that you should really be asking. Why is it that some people, the returns to education have changed, for example, right? So I mean, why is it that that certain skills that people got in the labor market in the past now seem to be no longer as valuable as they were in the past, whereas other skills seem to be very, very valuable in the labor market? In a competitive labor market, you have a situation where the wage, the salary is determined by supply and demand for a given set of skills. And so if you're trying to explain market income inequality, you've got to look to things like the returns to education. You have to look to skill-biased technological change. It used to be that there are a lot of professions out there where the unskilled could earn a fairly relatively higher wage than they can now. Why is it that technological change has evolved in such a way as to favor those with skills or with certain skills? And if you're upset that people at NVIDIA, the executives at NVIDIA earn a lot of money, why is it that their skills are so rare, that so few companies have the ability to design chips for AI that can power ChatGPT and things like that? Why is it the labor market is that way? Why are the skills for those people so rare, and the skills for others so common? Maybe the decline in unionization has had an effect here. A decline in collective bargaining is possible. And globalization, of course, the globalization of skills and the ability to hire people all over the world to do work where before someone could only hire locally or in person. That's changed things dramatically. I mean, for example, just in the area of economic research, I mean, there are companies in the developing world, in India, for example, that economic researchers hire to help them process their data. And you can just do this remotely and seamlessly. It used to be that you would have had, I would have had to hire, I haven't used these companies, but someone like me who was hiring them would have to get an army of Stanford undergraduate research assistants to do this work, right? I mean, that's expensive compared to being able to employ people in developing countries to do it, and those people now have an additional opportunity that they didn't have before. I don't think any of these particular explanations individually can explain the increase in market inequality, but I think you have to look to all of them if you want to try to disentangle what's causing it. And if you want to solve income inequality, don't worry so much about is the government doing enough redistribution and so on, because you can quibble with this or that about the figures, but the fact is that the government has done a lot over the past decades, keeps doing more and more redistribution that's kind of offsetting this increase in market inequality. The question is, why is market inequality increasing? And how do we make sure that more people have access to skills that will allow them to be prosperous in the labor market? How do we ensure that access to education and to gaining skills is appropriately distributed and not excessively concentrated? So I think if you want to solve income inequality, You have to grapple with those forces. And also, I think if you want to address another question, you might say, okay, but why don't we just keep doing the redistribution? Like you were saying, why don't we just keep going? Like we could just keep raising the tax rates. If market inequality increases more, well, don't worry about it. We can just raise the tax rate to 75%. Well, remember, all this redistribution is actually quite costly because the more you tax people, the less economic activity you get, the less business activity you get. The more you tax them, the more deadweight loss you get. That was a point I made Monday that I'll reiterate, which is just that the Laffer curve is one kind of debate. What's the rate you could set to maximize government income? But that's kind of a bad question. The real question is what Marty Feldstein asked in the 1990s, which is what is the societal loss, the overall economic loss to the level of taxation that we have now? So a much less costly way, costly to society as a whole, much less costly way of addressing income inequalities is to look at, I think you got to look at the education system in a lot of countries. Why is it that some people are gaining access to valuable skills in the labor market and others are not? Why is it that there are some skills that are so rare in the labor market? And I think a lot of it is you're gonna find that a lot of it has to do with education systems. It all goes back to education and training and how people get the training to be productive in the labor market. That's where you should look if you want to explain income inequality. So that's the lecture that I wanted to give. Income and wealth inequality have received a lot of attention from the media and politicians, but I think it's often overstated. And the United States' tax and welfare system is already very progressive. It's gotten more progressive, particularly on the benefits side, as the size of government as a share of GDP has increased. Government benefits have increased through both federal and state policy. That's been alleviating a lot of the increase in inequality or undoing a lot of the increase in market inequality. More redistribution has got a lot of pitfalls, and those pitfalls may be worse than the problem that it's trying to solve. The cure may be worse than the disease. When you think about how additional amounts of taxation are just going to reduce economic activity, and if you want to address inequality, which I think is a perfectly good thing to want to address, focus on opportunity in the labor market and the supply and demand for skills in the labor market, not how do we structure tax policy to tax the rich more and give more benefits to the poor, because at some point you're just running up against the constraint that you're not going to be able to tax the high income people forever without losing a lot of economic activity and prosperity. So we have a few minutes for questions. Yeah.
I wanted to ask, how do you think, if at all, the government should address the, say, top 100 net worth people, which especially in the U.S. is a group that gets focused a lot in the media, people like Elon Musk and et cetera?
Well, what needs to be addressed? I mean, you want me to tell you whether I think they're paying too little taxes or too many taxes? I mean, we'd have to have another poll.
Should they be addressed as a group different than, say, the top 1%, or not at all?
Well, I guess I'm hesitant to answer a should question. I mean, I'd want to look at the facts about how much income they earn and what are the rates at which they're taxed and what percentage of the kind of total tax burden are they bearing relative to the amount of income that they are earning. And I think I'll hear a couple things that I think I'm pretty confident are true. So number one is, as is the case with the top 1%, they are they're bearing a larger share of the tax burden than their total earnings are. That's also going to be true, just like it was for the top 1% in the U.S. They earn 22% of the income. They pay 44% of the taxes. Or in Israel, the top 20%, they earn 44% of the income. They pay 92% of the income taxes. So that's going to be true for them. I also think they probably do have access to a lot more tax sheltering types of activities than say a top 1%er who is not in that range. And so I guess I think the way to, if you think there's something to be addressed there, if that seems unfair, or if their average tax rates, if you find somebody whose average tax rate seems to be low relative to the income that they're earning, has to do with simplifying the tax code. Let's simplify the tax code. Let's get broaden the base, meaning eliminate loopholes in ways that that people can shelter income, avoid taxation, and lower the rates for everybody. And then you'll be in a situation where what they're paying in taxes relative to what somebody who's a top 1%er but not them, or a top 5% or 20% is paying, will seem fairer, because it won't be the case that some people have access to some special loopholes or deals. So that's probably what I would do. Yeah.
In wealthy nation, you have natural gaps between the poor and the rich, and richer areas and poorer areas, like Wales in the UK and in London. And you marginalize those by taxation and by minimum wage and investment. So my question is there any way we can actually address the question of the poorest human on earth? You had one slide about the global inequality.
Yep.
And it seems to me that once you don't speak the same language and you don't live in the same country, there is no practical way to invest and to take the very poor out of the backstreet.
Well, there are a lot of things that could be done. If you took the government budget for welfare programs in the United States and you cut it by 5%, and you took that 5% and you said, I mean, this would be something that only a sort of benevolent dictator could do, because Congress is never going to pass it in the United States. But you took that and you said, what good could I do with that in the world, in Africa or in India? There is so much you could do in terms of vaccination against diseases, clean water, hunger. I mean, there is so much you could do with that with that money. It may be that it's impossible to politically impossible to do that, because, you know, in a democracy, people want to vote for their resources to they want to believe that it's going to help them. But if you're a high-income person, you're thinking, what could I, you know, where is the money best spent? You got to look at things like that. You know who's got a good sort of list of relatively inexpensive things that you can do to really improve the developing world is Bjorn Lomborg. So Bjorn Lomborg is a climate scientist, and his whole thing is he's not a denier of global warming. He's not. He actually doesn't get into the sort of debate about science the way that Steve Koonin does. He kind of accepts the science, but he says if you look at the various ways that people are proposing to remediate climate change, and you look at the costs of those and the cost of climate change to humanity, and you compare what you could do with that money to what that money would do to address malaria. I think the number one is malaria in Africa, to get clean water to people, things like that, that those have a much higher bang for the buck. And so I wish we could move more towards thinking in that way. You know, if we really think we're helping people, if you put a constraint on it, you say, well, you just can't dedicate, you know, U.S. or UK money to go to Israel and alleviate, you know, malaria, then you could argue maybe that what we're doing here is second best. But I do think that there's an awful lot that could be done with resources of that level.
Personally, I believe that all those claims about inequality, that's my personal view, is the essence of jealousy. I don't think it's like have any truth embedded in it. And eventually, I'm rich. It means that I did a lot of good to a lot of people, like more than other individuals. So not only you are punishing me for that, I'm paying, even in the flat tax, I'm paying just a bigger amount of money. Now you are extra punishing me and giving either higher tax rates. But I think that beneath all those claims, it's a political fear. People are afraid that eventually, subconsciously even, that eventually if you are getting richer than me, and you are getting more and more richer than I do, or my group, so eventually you put a price tag on my life. Eventually you conquer all the power, all the political power. So it's a governmental mechanism question, not tax question. I think we should go to the root cause and not going around the bush.
Okay, so you say that you believe that the main concern that people have is that, you know, like Jeff Bezos and Mark Zuckerberg and folks like that are going to like take over the world, and then what are they going to do when they take over the world? I mean,
I just fear of it.
Yeah.
It's like aliens from financial, you know.
Well, Interesting. I don't know if that would be worse for lower income people than the government we have now, but it's an interesting question interesting question to ask. Yeah. They still might fear it. Yeah.
Change the political mechanism in checks and balances and something like that, in a way that your money won't be an abstract or an inequality,
Yes.
but not with a tax.
Right.
So,
Well, an interesting set of ideas, and let's discuss that more over break. I mean, that's an interesting set of ideas. A good road to go down. Okay. All right. Thanks. All right.